Welcome to the Fit Rich Life podcast, a show where we talk about money, investing, financial independence, and building a life you absolutely love. In today's special guest episode, we welcome J.L. Collins back to the show. He first appeared on the podcast in episode 71. His newly updated book, The Simple Path to Wealth, has sold over 1 million copies and is now a New York Times instant bestseller. J.L. Collins is known as the Godfather of Financial Independence, and he has so much wisdom to share about the journey to financial freedom. He has played a big role in my own money journey since I first discovered J.L.'s Simple Path to Wealth framework back in 2017. In this episode, here are some things you will learn about. 1, does the Simple Path to Wealth still work? 2, do bonds have a place in your portfolio? 3, do you need an international stock index fund? 4, J.L.'s stance on Bitcoin and crypto. 5, staying the course during a stock market crash, and a whole lot more. This is a great show for anyone interested in pursuing financial independence, as J.L. shares his wisdom from 50 years of investing. This wisdom will empower you on your own journey to financial independence. Please enjoy a wide-ranging conversation with J.L. Collins. J.L. Collins, welcome back to the Fit Rich Life podcast. So good to have you here.
Hey, Justin, it's great to be back. Thanks for having me again, man.
Well, I'm really excited to have you on the show because you just released a newly updated version of the Simple Path to Wealth, which not only sold over 1 million copies, but it is now number 7 on the New York Times bestseller list. So really excited to dig in to more conversation with you, covering some new territory from what we covered in episode 71 previously.
Yeah, looking forward to it. And thank you. Yeah, the news on the New York Times bestseller list just came out yesterday. And I self-published the book originally back in 2016. And I guess the New York Times won't look at self-published books, but the new edition, I actually have a publisher. And so it became what they call, and who knew, but I certainly didn't know, what they call an instant bestseller. So the moment it was released, it shot to the top. Or to number 7 anyway. So that's pretty cool.
Yeah, well deserved too. Honestly, I've said this to friends. I've said this in online posts, but like your book, The Simple Path to Wealth, is my favorite book on investing in money. And as I talked about in our previous conversation, episode 71, it really played a pivotal role in my own financial independence journey. So super excited to have you back.
Yeah.
A quick little blurb for the listeners. No need to listen to the last episode that JL was on the Fit Rich Life podcast. I'll put a link, though, to the episode 71 in the show notes because we covered a ton of stuff. We covered FU Money, The Simple Path to Wealth, Pathfinders, another one of JL's books, tech sector investing, stock picking versus index investing, rent versus buy when it comes to like your home, and a whole lot more. So it's definitely worth a listen, but you can also listen to this podcast as a standalone because we're going to cover a bunch of new territory in this episode. So, JL, what inspired you to update the Simple Path to Wealth for 2025?
No, great question. You know, the truth is I didn't really plan to do it. About 1.5 years ago, I started thinking about my mortality, candidly, and wondering what to do with these assets, these 3 books that I've published over the years, and The Simple Path to Wealth, of course, being the giant of the 3. And with that in mind, I reached out to some of my other published friends and got the names of their agents and reached out to those agents. And I had a couple of ideas around actually selling the assets like some musicians have done recently. And most of the agents said, well, that's an interesting idea, but it's never been done in publishing. But one of them, Molly, who is now my agent, said, well, that's an interesting idea. It's never been done in publishing, but let me see what I can do. So we created an offer sheet for it. And we shopped it around, and to six different publishers that she thought it would be a good fit for. One declined to participate. Four made cash offers, one of which was pretty tempting. But then the fifth one said, "You know what we'd really like to do is take it on and do a new edition." And I at first was not enthusiastic about that idea, but I had engaged my daughter, who is now an adult, in this process, and I'd said to her, whatever I decide is probably going to affect me for about a decade. It'll affect you for half a century or more. So you ought to participate in this. And so she did, and she was looking at these different opportunities. And at one point, to my great surprise, she said, Dad, I think we ought to go with the publisher. We ought to continue to own the asset, the book. We ought to go with the publisher and update it because I want to be involved in it. I want to have it in my life going forward. Well, this was just stunning to me because, Jessica had always had very, very little interest in this. She was following the simple path to wealth. She's in her early 30s now. She quit her own corporate job last fall, so it's worked out well for her. But I had no idea that she'd taken as deep an interest or had as deep an understanding in the work as she had developed. And so suddenly I had this chance to do a cool new edition of the book with a pretty exciting publisher and work with my daughter in the process. And that was enormously gratifying. So that's kind of how it came about. And I'm really thrilled with the result. I'm very proud of the original edition of The Simple Path to Wealth. And as you mentioned, it sold over a million. Yeah, there you go. Sold over 1 million copies. So obviously successful. Quick little story, by the way. In January, when we were deep in the editing and revising process, which is pretty tedious, laborious kinds of somewhat unpleasant work, candidly, I was talking to a friend of mine, and I hadn't told anybody that I was doing this. I was talking to a friend of mine, and out of the blue, he said, the great thing about The Simple Path to Wealth is it's timeless. You're never going to have to update it.
Was that Jordan?
Oh yeah, exactly. That was Jordan, and I'm slapping my head and thinking, he's right. What am I doing here? But I'm glad I did it because, as proud of the original as I am, I think the new edition is actually a better book.
Yeah. Yeah, the first edition is so good. I think I've read it maybe 3 times, the first edition. And then I spent this morning kind of like skipping around the new edition. And there's a lot of there's new good stuff in the updated edition. And I told you off air, I've listened to 5 or 6 episodes of your, interviews about this new edition.
Yeah.
And I know whether you own the first edition or second edition, they're both good. I think what's 2 things. One, what is the simple path to wealth? So this is for the listeners who didn't catch episode 71. What is the simple path to wealth? And then let's start to dig into, does it still work?
Okay. So first of all, I would say what is unchanged between the original and the new edition is the core path itself. So for anybody listening to us who, like you, have read the original version and maybe are on their own journey on the simple path to wealth, it's the same path. So the new book has additional material and information, and everything's updated and that sort of thing. But the path itself is unchanged. And basically the formula is very simple. It's avoid debt, organize your life so you're living on less than you earn, and then you take that surplus and you invest it to buy your freedom. And you buy your freedom by buying assets, and specifically broad-based, low-cost index funds. And my personal favorite there is VTSAX, which is Vanguard's Total Stock Market Index Fund. And we can delve into why I like that particular one and why I like Vanguard. But that's it in a nutshell. And those basics are unchanged. And I'll give you a quick preview. We can also dig into it a little more if you like. Is the simple path to wealth still valid? And the answer to that is absolutely. I'm always kind of amused at that question because the simple path is designed to be implemented for decades. My daughter, for instance, is going to be following the simple path to wealth for the next half century or more. So it is designed to weather all kinds of turmoil, whether it's a pandemic or political upheavals like we're going through today.
Yeah, which is what I want to delve into with you today. So, the elephant in the room, it's, as we're recording this, it's the end of May, 2025. And like we've had so much stock market volatility in this, first 6 months or so of the year. And, a lot of that is attributed to the tariffs and global tensions and kind of like, related, we're not going to get into the politics of it, but I'm just
Right.
like, how can investors reframe what, all this volatility, this downturn, um, in a powerful way that's going to set them up to be a successful investor over the long term? Because I've seen people online saying oh, they cashed out their entire portfolio and all this stuff. So, what is your take on all this stock market volatility that we've been experiencing in 2025?
Yeah. So if you roll back a number of weeks, the market when it was dropping got down almost not quite 20% at its lowest from its peak. So just shy of an official bear market. And at that point, nobody would have predicted that just a few short weeks later, now it would have recovered all that and we're back in positive territory. But when it was down, around that 20%, my social media was, and still is for that matter, was lighting up with people who were in full panic mode. And to those people, I would say, hopefully you didn't sell then, but if you were terrified with that drop, the market is now giving you a get out of jail free card, a gift, because now you can adjust your allocation, your portfolio, with no loss because the market's back where it was. And of course, now people are saying, well, maybe it's not so bad, So
Yeah.
let's be clear. As I was saying then, and I'm saying now, I have no idea where the market goes from here. I don't know if the volatility is over and it's going to begin its relentless climb up again. I don't know if this is what they call a dead cat bounce and it's going to drop again to much deeper levels. And you know what? Nobody else knows the answer to that. I mean, you can turn on your television and find lots of people who will tell you they know the answer to that, but they don't because nobody can see the future. What I do know is over the years, 10 years, 20 years out, the market will be higher today. And if you stay the course, you keep investing, you will wind up becoming wealthy. And if you do that, if you're in it for the long term, as the simple path suggests you should be, then when the market gets volatile like it's been these last couple of months, that's a gift because you're putting in money on a regular basis every month, every few weeks. And when the market drops, you're buying shares on sale. So if the market were to plunge from here and you're accumulating your wealth, it shouldn't be a time to panic. It shouldn't be a time to be scared. It should be a time to celebrate as wow. I'm putting this month's $1,000 in, and I'm getting even more shares than I did last month. So
Yeah.
that's my take on it.
Yeah. And that's I learned this from you, but I really see every downturn as stocks on sale, because I'm still in the accumulation phase
Right.
for the most part. And so it's great. And the other thing I learned from you is as long as I don't sell, I don't lock in losses, right? So
Right.
I
Right.
I may have to wait a year or, in this case, a couple months for it to return back to where it was.
Right.
But as long as I don't sell, like, I haven't actually accrued any losses. And, the other principle I like to think about for me that kind of helps me stay calm when the market is dropping is like, I just zoom out like 1, 2, 3, 4, 5 years. And if I zoom out 5 years and look at my investments, I'm like, wow, I am so far up from over the last 5 years or the
Right.
last 10 years that like this drop, yes, I'm down where, from where I was a few months ago, but I'm still massively up from where I was 5 to 10 plus years ago.
Sure. So just to be clear, uh, COVID, we went through the same pattern. It went down sharply and then it rebounded almost immediately.
Yeah.
That's been the same pattern this year. It went down sharply, it rebounded very quickly. As I said a moment ago, nobody, including me, knows where it goes from here. But make no mistake, the market can go down and stay down for extended periods of time, as long as a decade. So these quick reversals of a downward trend are not something you can necessarily count on. But that's not bad news. That just means if you're accumulating wealth, you have a longer runway to buy those shares at a discount price. I mention this because I imagine for a lot of our listeners, they've never experienced anything like that. The last time it happened was the first decade of this century, from 2000 to 2009, when you had the tech crash in 2000. The market went down about, I want to say, 46%. Then it bumped along, pretty much not doing anything for a decade. And then we had the debacle in 08, 09, where it dropped another 56%. So kind of a lost decade, but a golden buying opportunity. So if you had been on the simple path to wealth in 2000 and you didn't let that crash rattle you and you kept buying for the next decade, well, then beginning in 2010, which has been, as you just mentioned, your own performance, a record bull market of almost 15 years has volatility in it, as the markets always do, but a relentless rise up for 15 years. Think of how well you would have done with those shares that you bought it during that decade.
Yeah.
So, yeah, make no mistake, don't expect it necessarily to go rebounding up immediately every time, but it's okay if it.
Yeah. Question about that. So one of my 5 friends, we love to talk about the stock market. And we were talking a few weeks ago or a few months ago about it seems like the downturns are shorter and shorter more in the last decade or so.
Mhm.
They're just like, for example, COVID hit, market dropped I think 34+%.
Just
And
shy
then
of
five
that,
5 months later it was back to all-time new highs, right?
yeah. Yeah, and it recovered that loss within a couple of weeks. I mean,
Yeah.
that was probably the most V-shaped decline in recovery in history was COVID. So that was
Yeah.
highly unusual.
Yeah, and so I guess one of our question like that we're debating is like, is the financial infrastructure of like quantitative easing and all those things, is it like, are we doing a better job of kind of managing the like economy downturns like that and like helping kind of like right size things better? Or is like, should we just assume that at some point we're going to have a extended downturn?
So my guess is that at some point we'll have the extended downturn. Uh, the one macro change that I've been thinking about and that I think may have some validity suggests that one of the reasons the downturns are not quite as deep as they could be and turn around fairly quickly is that retail investors, which means people like you and me, right? We're the what used to be called the dumb money on Wall Street, right? So the old saw used to be that when the market dropped, the individual investor, the retail investor, was the first to panic and do all the wrong things and sell at a loss. That was the dumb money. And the professional money runners knew better, and they were the smart money. But I think these days, that retail investor has gotten the message, just like you described you have, that they don't worry about downturns. And if anything, they see it as a buying opportunity. And by the way, if that's true, seeing as I started talking about this back in 2011, which is sort of when that psychological change began, I'll take some credit for it because I think mine is one of the larger voices on beating this particular drum. So I think that's it more than anything else. The retail investor is just not prone to panic.
Hmm.
They're a little more sophisticated maybe than they were in the old days. Now, having said that, I think part of it is that they've never lived, many of the younger ones have never lived through a long downturn, and they are used to things turning around. So let's suppose the next time it drops, it doesn't turn around in a few weeks or a few months or even a couple of years. Will, if it turns out to be a decade like the first one of this century, will they still 8, 9 years later be holding on and building their wealth into it? That'll be the acid test.
Yeah.
And I think that's a much harder road. It takes a lot more deep understanding of how the market works, and frankly, a lot more courage to walk that road than, I mean, because with COVID, it turned around so quickly, and with this recent volatility, it turned around so quickly, you almost didn't have time to react to it.
Yeah.
So, yeah, but I think, I don't think fundamental market behavior is going to change. I think at some point we'll have a protracted downturn, and I have no idea what'll trigger it, but yeah, I would not be surprised to see that. And whenever people start saying, things have changed, this time it's different, it's probably when you're about to be surprised. Somebody once said the market will do whatever it takes to embarrass the most people.
Yeah.
So there you go.
Yeah. I was looking up before this conversation and kind of how often crashes and corrections occur. And I think it's valuable to share. So a market correction, like going down 10% or more, approximately every 1 to 2 years
Right.
is when they happen. Duration, a couple months or a few months. Bear market, market goes down 20% or more, happen every 5 to 7 years or
Hmm.
so.
Sounds right.
And they can last, around 13 months. But like recovery could take up to 2 years.
Hmm.
And then a major crash, which is like, 30% up to 50% or more drop, uh, happen every 10 to 15 years, but it's been longer than 15 years since a major one has happened, right? Like, I mean, I guess COVID was over 30%, but it was so short lived.
Right.
Um,
It almost
so
doesn't.
I, yeah, that's why I'm like, oh, we like, in for one. So before we move on to the next section, which is bonds, what I want to talk about, um, when that next extended downturn happens, how
Right.
does somebody like me who hasn't been investing during an extended downturn, because I was in college, from
Right.
2002 to 2006, and then I was not even paying attention to the stock market, you know up, between 2000 and 2009. So like, how does somebody like me like mentally prepare for a extended downturn if and when we have one?
Yeah. So let's talk about how often they happen. First of all, there have been three I've been investing for half a century, God help me. And there have been three in that time. One was in the 70s. It actually started in 1974, which was the year before I started investing in 1975. And, the 70s were the decade of stagflation, high inflation, a stagnant economy, which is a really, really ugly economic situation. And that lasted for about a decade, up until about 1982. And then the second one, and I've already alluded to, was the tech crash that that came in 2000. There were, to be clear, there were others. There was Black Monday in '87, which was the single biggest daily drop in the market history until then, and since then it was, I want to say, 24% in one day. But that turned around in about a year. But then, we had the tech crash in 2000 and the 08, 09 financial crisis. So those are kind of the three big ones in my life, and averaged out in that 45, 50-year period, that is about, one every 15 years. But as you can tell, they don't happen on a regular basis, right? Just like the corrections don't happen reliably every couple of years, or bear markets every 5 years. So there's no predicting when the next one will come. And now I've forgotten the other part of your question.
So the question is when the next extended
Oh,
downturn
right. How do you,
or bear market or crash occurs, like in my experience, it's like, oh, cool, the stock market goes back after up, at most, maybe a year.
right?
But like, what happens if it's a multi-year downturn? How does somebody like me like hold the line?
Yeah, that's a great question. It's one of the things that I wonder about in my writing is, can people read what I've written and maybe listen to the interviews I've done and take that to heart enough to endure something like a 10-year dry spell? Or do they have to live through it, make the mistake of panicking and selling out maybe 5 years into it, and then living to regret it? I hope they don't have to have the actual experience themselves to learn the lesson, that they can just listen to what I'm saying. But I think, to answer your question, about all you can do is really take the time to listen to a conversation like this, understand why the market will come back eventually, appreciate the fact that if it stays down an extended period of time, it has given you a buying opportunity that will ultimately benefit you, and have faith that it will again, as it always has, resume its relentless rise up at some point in the future, and that will be very, very unpredictable. And I don't mean to suggest by any means that this is easy. So the example that I will give is in the financial crisis, right? Let's suppose that you started in '07, you had $1 million invested. And then '08, '09 happens and the market drops a little over 50%. Let's make the math easy and just say it drops 50%. So in the beginning of '09, your $1 million is now, well, actually, let's make the math even easier. Let's say you got $1.2 million. And so at the beginning of '08, '09, it's been cut in half, and you now have your $1.2 million has become 600,000, right? That's going to be tough to swallow. Now, '09, in March of '09, actually was the low. And from there, the market turned around and it's pretty much gone steadily up from there. But nobody knew that at the time. Nobody was saying this is the low. Nobody's saying, hey, you stayed the course, you did the right thing, and good times are coming. What people were saying in those days, all the smart money I heard, was that it was going to go much lower. They were predicting it was going to drop 2/3 from that point further down. So that means now you're sitting there having lost half your $1.2 million. You've got 600,000, and the world is telling you pretty soon that's going to be cut to 200,000. Do you still stay the course? That's the question. And I think the only way to do that is to think it through now when times are reasonably good. So a few weeks ago, on the blog, when the market was down 20% or just shy of it, there was a woman who logged onto the blog with a comment, and she said, and I'm paraphrasing, she said, basically, I understand the simple path to wealth. I think it'll work, but I have just learned that I can't tolerate this volatility. So I'm selling. I'm going to go to cash. And of course, nobody knew at that point whether the market was going to go down another 20% or 30% from there. Certainly nobody expected it to rebound that quickly. But what I would say is look at how you felt just a few weeks ago when the market was down 20% and could well have continued down. If that was keeping you up at night, you need to rethink your allocation. And if you're not 100% convinced that you can stay the course and continue investing when the market drops, you do not want to be following the simple path to wealth, because if you panic and sell during those times, it will leave you bleeding at the side of the road. I just put a post up on the blog a couple of weeks ago or a week ago saying this is the single, I forget the exact title, but something effective, the single thing that will determine whether the market makes you wealthy or leaves you bleeding at the side of the road. And the answer to that question, and it's what the post is about, is what you do when the market drops. And if you're not completely convinced that you're going to do the right thing, which is nothing, staying the course, continuing to invest as always, then you want to probably look for a different approach. And this couple of months ago was a great litmus test of how you emotionally handled that. Will tell you a lot about how you could handle something much worse. If you rolled over and went back to said, oh, that's interesting, down 20%, you rolled over and went back to sleep, you're probably good to go. But
I'll,
if not,
yeah, I'll tell you what I did. This year, I reread your book. So when all the volatility was going on, I was like, I just need a voice of like wisdom and reason, like telling me to just like keep investing, don't sell, stop freaking out. This is totally normal.
that's right.
And like, and so again, like I haven't been investing through an extended downturn. So this is, obviously, and when COVID hit, I had, read your book, a few years prior.
Right.
And I was like, awesome, let's just keep buying. And so that was, I was really proud of myself for
Right.
during that time for COVID. But I was also making like a sizable salary that time.
Mm-hmm.
And the difference this time is I've stepped away from my 9 to 5. I make, money part-time from my online coaching business and some from the podcast, but not nearly as big as that, like,
Right.
fire hose of cash coming from a high paying sales job in tech. And
Right.
so this time I had to go reread the book to be like, calm down. Like, even though you don't have the, fire hose of cash, like keep investing, don't sell. And that helped me. So for
So
the audience,
did
go
you
ahead.
listen to my guided meditation?
I didn't. I know it's available and I'll put the link in there.
Yeah.
I just reread the book because, like, and I'm going to stroke your ego for a second. JL, the thing I love so much about The Simple Path to Wealth is most investing books are incredibly boring and hard to read. Like you like have to struggle through them. Where
Right.
is The Simple Path to Wealth? JL writes in a way where it's like a storytelling session, like a fireside storytelling session. And it's just so easy to read and so easy to understand. And it's like fun to read. And so for me, it was really fun, like reading again for the third time. And that like kind of programmed my mind, even though my mind wanted to be like, oh, like you're down, your net worth is down $400,000. Like, what's going on? It
Yeah.
was like, nope, I'm just sticking to the simple path to wealth.
And it's also, it's like, wow, I've got so much worth that my net worth can drop $400,000 and I'm still okay. I remember in 08, 09, Warren Buffett's portfolio was down something like $60 billion. And, and I was running around irritating my friends by saying, wow, I wish my portfolio was down by $60 billion. Because of course, it was the market had cut it in half, which meant that he still had $60 billion.
Yeah.
Right. So
Yeah.
yeah, it's a measure of your wealth when you get to the point where market fluctuations up or down at some point will become more than you made in a month. And
Yeah.
then it become more than you made in a quarter. And then those fluctuations be more than you made in a given year. I mean, as your portfolio grows. So
Yeah.
yeah,
I mean, it was crazy. So we had an incredible year last year and the year before. And I like looked at my investments and like in 1 year, because I had enough invested, I made over $600,000 increase in my net worth from doing nothing.
right.
Like
In your sleep.
like doing literally doing nothing. And I was like, this is the most incredible thing in the world. And as I was, I said earlier, like the two things I did during the volatility of this year was I reread Jail's book, but then I also zoomed out on my net worth tracker so I could see, like, hey, I'm still way up from 2 years ago, 3 years ago, 4 years ago, 5 years ago. And then one other note is I don't know if you've updated the audiobook for the second edition, but the audiobook for the first edition is in Jail's voice. And if you like listening to his voice like I do, it's a great audiobook as well. So
Yeah.
for anyone who doesn't like reading books, like listen to the audiobook and you have this great storyteller in your ears telling you to stay calm when the markets are volatile.
Yeah, just to answer that question, by the way, my contract for the audiobook with Audible runs through 2027.
Oh,
So until that contract runs through, I won't be able to do a updated version of the audiobook. So for the next couple of years, it will still be the original edition in the audio version if people
yeah.
want that. But again, the basic philosophy and approach is the same in the original, and so you're going to miss some of the cool new stuff in the new edition, but
Yep.
the basic message and how to implement it is still there if audio is the way you prefer it. And by the way, I'm not entirely sure I will be recording the audio version of the
I
new
really
edition.
hope you do
Yeah, a
because your
lot of
voice
people.
is so amazing, Jail. Like, please,
Yeah,
if there's any way for you to finesse it so it's you speaking.
well, a lot of people tell me that, and it's very flattering. And I for that reason, I would like to do it. But recording an audiobook is drudgery. I mean, it's a remarkably unpleasant task, and I kind of dread it. I with Pathfinders, my collection of 100 stories of people who have been following the simple path to wealth. Uh, when we did the audiobook for that, my publisher sent me clips of various professional voice actors, to male and female, to do different parts of the book. And I kept wondering if they would ask me to do it. And I was thinking about how I would respond. And I was sort of dreading being asked because I really didn't want to do it. But they never asked. So we picked a couple of professionals, and it turned out pretty well. Although I have had people tell me that they're disappointed that I at least didn't do the parts of the book that I personally wrote as opposed to the stories that are collected.
Yeah.
So we'll see. We'll have to wait and see how I feel about it 2 years from now.
Yeah. Well, let's transition to bonds because there's kind of been another kind of big kind of uh fiasco. I don't know what the right word is, but like the US bonds have been downgraded. And so I have people being like, oh, like my friends, even some of them financial independence people being like, bond, like get rid of your bonds. Bonds don't work anymore. And so, of course, like knowing that I have JL coming on my podcast, I'm like, okay, so what is JL's thoughts on like are bonds still an important part of one's portfolio, especially when they're in the wealth preservation phase?
Yeah, so that's actually a pretty big question, but the short answer is yes, they are still part of part of the simple path approach. So you covered a lot of ground. Let's talk about the downgrade specifically of U.S. debt, which is not all bonds, of course, are U.S. debt. And the other two rating agencies had already downgraded U.S. Treasuries. So this was the third one that was sort of the last of the party. And the other two, it didn't really move the needle in any significant way when they did it. The fact that this third one has fallen a line and downgraded it isn't going to move the needle either. A couple of reasons for that. One is they are still very, very highly rated. So one of the problems of listening to the news media is everything's a damn crisis. And so you would think this is the end of anybody buying a U.S. Treasury, which of course is nonsense. They are still the single safest investment in the world. They are slightly less so than they used to be, but there's still nothing else that compares to them. The other part of that you didn't ask about, but it's kind of linked into it is, well, is this going to derail the US dollar from being the world's reserve currency? Because being the world's reserve currency is a great advantage that the United States has enjoyed ever since World War II. And the answer to that, and make no mistake, these downgrades are not a good thing. I'm not suggesting that, but they are not significant enough to change that. Because one of the things you have to ask yourself is, well, if not the US dollar, what currency is it going to be? There are only two contenders I can think of, the Chinese yuan, and nobody trusts the Chinese to be the world's reserve currency, so that's not going to happen. And the euro, which is just not strong enough to play that role. And to be clear, there are many countries in the world that would dearly love to see the US dollar dethroned and have felt that way for decades. And yet the US dollar remains dominant. So it's not like there has been no effort to dethrone it before. So I'm not overly worried about that. So more broadly speaking, let's look at bonds. Bonds in the last few years have had a very, very rough go. I mean, 2022 saw bonds drop 22%, something like that, which was, I think, an all-time record for bonds. And of course, bonds are traditionally considered to be a stable kind of investment. So when you have something that you expect some stability from dropping like that, it's pretty earth-shaking. And there were a variety of elements that came into play to trigger that. And then, of course, the bond market has been kind of roiling a little bit ever since. But that doesn't fundamentally change the fact that bonds play a very important role in the economy. So what is a bond? Well, a bond is simply a loan. It is an organization. It could be a government agency like U.S. Treasuries. It can be a city or a state issuing bonds to build dams or roads or power plants or whatever. And it can be corporations that issue bonds to expand their business. And if you are buying bonds, basically you are a lender. You are lending your money to that entity in order for them to finance whatever it is that they are doing. And of course, they're making a promise that they will pay you back the amount that you've loaned them, along with an agreed upon interest rate over a period of time. So, some bonds are very, very short term. Some bonds go out 30 years. All of that is essential for the economy to function because organizations need to borrow money in order to build and accomplish things. And people have a need to lend that money to earn an interest rate on it, as opposed to some other assets that they might choose, like stocks that are wonderful investments, but very volatile. So there is a need for bonds, and bonds will continue to be desirable. They will be made competitive by the interest rates that they offer, because the more uncertain people are about bonds, the more interest a bond issuer is going to have to offer. So, that becomes a self-adjusting thing. There's a category of bonds, for instance, called junk bonds. And these are bonds that are issued by organizations that don't have stellar credit. And because they don't have stellar credit, people buying the bonds demand a higher interest rate to compensate them for the additional risk of lending money to somebody with a lesser credit rating. So bonds are not going to go anywhere. Now, right now, I hear all the time, well, I'm done with bonds. I mean, bonds have been a pretty miserable place to be for the last couple of years. And that's true. But let's go back to our friendly neighborhood stock market, right? So let's go back to 2000 when the stock market crashed and delivered a loss of 46%, and then went on for another decade to go nowhere and until it hit another crash. Well, let's suppose that you were following the simple path to wealth then, and you said, okay, I'm okay with this crash. I'm going to follow JL's advice and I'm going to keep accumulating shares. And then the market just kind of didn't go anywhere, bumps along, and you start to get discouraged. And maybe 3, 4, 5 years out, around 2005, 2006, you say, man, these stocks, they're not going anywhere. I mean, the stock market is over. Business Week back in 1982, 82, 78, I forget which, ran a cover called The Death of Equities, predicting that, stocks were just going to disappear forever. And that was, by the way, marked the beginning of one of the all-time great bull markets. So let's suppose halfway into that century, '05, '06, you say, I'm done. Stocks they're a loser's game. And you would have happily felt vindicated for another few years. And then one of the all-time great bull markets would have begun and left you behind. So that's the situation you're sitting in bonds. If you step away from bonds because they've had a bad run for a couple of years, you do not have the long-term perspective that I think is essential to be a successful investor.
Yeah.
Long-winded answer. I apologize.
Yeah. I think the other thing that's challenging for people who are considering having some portion of bonds in their portfolio is like if you look up on like Yahoo Finance or Google Finance, like, VBT LX or BND, Vanguard's uh, bond index fund and bond index ETF, they don't show the interest payments in the chart. So it looks like it's like down for the year, but like with the interest payments, it's actually up for the year. And it's like I just realized that like a few weeks ago. I was like, wait a minute, they're not even factoring in like the interest that the bonds are throwing off like every quarter. So like I'm actually doing better than I thought I was doing as far as like my bond allocation goes.
Well, assuming you're reinvesting that interest, that's true. I mean, what they're reporting, and it's a legitimate way to do it, is the actual value of the underlying bonds.
Yeah.
So if they say, the BBTLX is an example, which is Vanguard's total bond market index and the fund I recommend and use. If they say it's down 2% for the week or whatever it is, that's the value of those underlying bonds in aggregate. And you're right, it doesn't include any interest that it might have been paying you. And that's something to be aware of. That the fact that these things are paying you interest on a regular basis does kind of soften the blow.
Yeah. So, personal question, kind of related to my own allocation.
Okay.
So, off air, I kind of mentioned to you that like the last year I stepped away from my high paying sales job. And I've been generating some income through my online coaching and the podcast. But the income that I'm making is less than my annual expenses. And I planned for all this. So I had like,
Sure.
a cash buffer to hold me over for 2+ years. And I put a little bit of money, probably about 5% of my portfolio in bonds, in addition to that cash holding. And when I was rereading your book, I was thinking through myself at this transition kind of period in my life, because, a part of me is going to continue to work on my online business and see if I can grow that income.
Right.
Um, and so I'm kind of like I don't know how long it's going to take me to do that. And again, I'm financially independent, but it's I'm spending down my cash reserves, but I haven't got to the point where I have to sell an investment yet. And so as I was rereading your book this year, I was thinking through the wealth accumulation phase versus the wealth preservation phase.
Mm-hmm.
So I'm kind of in this weird in between place where I am kind of in the wealth preservation phase because I'm spending more than I'm making,
Right.
but I've built up this cash buffer to kind of get me through this period. And then I either figure out how to make enough money online, or I go back and get a high paying sales job, or I just decide, okay, once I burn through my cash, I'm going to start selling my investments. And my question to you is, how do I think about the bond allocation at this kind of transition period? When should I add in more bonds now? If I'm at 5%, should I go to 10 or 15% now, up until I either start making more money online or I go back and get another sales job? I don't even know how to think through it. And I was like, okay, JL is coming on the podcast. I'm just going to ask them. And I know other people are going to go through a similar thing where they're
Sure.
taking a career break, and they're but they're trying a side hustle and seeing if they can get that side hustle to take off. And so I'm just curious what your, feedback or coaching to me would be in my situation.
So, first of all, as you've probably already figured out, there are no hard and fast rules
Yeah.
to apply to this. So, a lot of it depends on you and your temperament, along with your financial situation. So, the first thing I would look at my bonds and my cash as kind of a together. And
Yeah.
my first question would be, if you combine those two, you mentioned you have 5% bonds. Well, what would the percentage be with if you added your cash to the bonds of your total?
So the way I thought about it was total number of years of living expenses. Sorry, I didn't.
Don't think about it that way for this question. Think about, for instance, if you have $1 million and you said you've got 5% in bonds, so what is that? $50,000 in bonds, and you've got, say, $150,000 in cash, then you've got 200,000 in cash and bonds, and the answer to my question is 20%, and you're 80% in stocks.
Yeah. Let
I think it'd
me.
just be a ballpark percentage, Justin. You don't have to calculate it to the decimal place
It's dangerous doing math on the live on air.
on the
So
fly.
I'm going to do a rough estimate right now.
All right.
So the cash and bonds combined, what total
Yeah.
percentage? Sorry, audience.
Yeah. So that's
About 15%.
about 15%. Okay. So what that tells me is you're very aggressive on the equity side.
Yeah,
And
and one note, I'm still investing some of the cash holding every month because I can't stop investing. So I'm taking from my cash and I'm investing it into, not bonds, into VTSAX. So I don't know if that's a good idea or a bad idea.
so that 85% in stocks is steadily growing, and the 15% in fixed assets is steadily diminishing. So yes, I mean, you are even more aggressive. Uh, I guess my advice would be, if you and I were having this conversation as you were approaching leaving your job, would be looking at your portfolio and figuring, say, a conservative withdrawal rate of 4%. 4% is very conservative. How close to the edge are you? So what do I mean by that? Let's again say you have $1 million, 4% would be $40,000 a year. And Justin, if you were to say to me, hey, man, I'm financially independent, but I need every penny of that $40,000 to make this work, then I would say to you, you want to have a pretty conservative allocation. You want to have more bonds,
Hmm.
maybe as high as even 40% bonds. I never, by the way, recommend going more than 50% bonds. And the corollary of that is going less than 50% stocks because you need stocks to be the engine of growth that allows your portfolio to survive over extended periods of time. I'm not even comfortable going down to 50-50, but 60-40 is about as bond heavy as I would get with bonds being the 40. If, on the other hand, you said to me, hey, JL, 4% throws off 40,000. Right now I meet all my living expenses and 30,000. And then the other 10,000, I used to play with. I like to travel, things that would be easy to cut if the wind turned in your face. Well, then I'd say to you, you can probably be a little more equity heavy because bonds, while they tend to smooth the ride, they're also a drag on your performance. And stocks, while they drive the performance, are volatile and can catch you out if you happen to need the money when the market is going through one of its down periods. But if you could easily say, hey, you know what? If some bad thing happens, I don't have to spend that $10,000. I don't have to take that trip. That allows you to be a little more aggressive. If you were also to say to me, hey, JL, I need every penny of this 40,000 to live on, but I know that if I wanted to, I could pick up the phone and get back into a high-paying sales job tomorrow. Well, that mitigates your risk of carrying a lot of equities. So that's kind of the way I would think about it.
Yeah.
And that hopefully is helpful to other people listening because everybody's situation will be a little bit different.
Yeah. I think that is really helpful for me because, um, and let me see if I can recap this, make sure I understood it right. And
Sure.
give a second chance for um,
Listeners.
the listeners to make sure that they got it. So essentially, you're saying if you're right at the edge of the 4% safe withdrawal rate, meaning like, okay, if you have $1 million portfolio and you take 4% of that, and your annual cost of living is $40,000, and you're unsure about your ability to go get a job and make more money, you would recommend going more like heavier in bonds, like 60
Right.
40, like stocks to bonds, or 70-30. Um, but if on the other hand, you are super confident that like you could pick up a job in a month or two, like good paying job that covered all your living costs and more, then you could be more aggressive and be 80-90% plus in equities. Did I get that right?
Yeah, and the other thing I would add to that I didn't say the first time, so it's not like you missed it, is you've got a side business going on that's throwing off cash,
Yeah.
and to the extent that that's throwing off cash, even if it's not covering all of your expenses, it's covering a portion of them, and the larger that portion is, again, the more aggressive it allows you to be. So
Yeah.
let's suppose you've got that $1 million invested, and that you can pull 40,000 on, but you're spending 80,000 a year.
Yeah.
And your business is throwing off 50. Well, now, between the 40 from your investments and the 50 from your business, you've got 90. You're pretty golden,
Yeah.
right? But let's suppose your business is only throwing off 30 so far. Well, now you have a different analysis to do.
Yeah. Then I have to get my wife to make more money so I don't have to go back to work.
That's always the solution. I think that somebody actually coined a term for it called spousal retirement or something like that.
Yeah,
Whether
or Wi-Fi.
it's or Wi-Fi, or let's let's not be sexist or husband fi
Yeah, it's spouse fi. That's much
if
better.
you're
Got to be
the
PC.
wife
You're
in
right.
the relation. Yeah,
Yeah.
yeah,
Cool. Well, that was really
absolutely.
helpful for me because I'm pretty confident. Like, if I needed to go either make more money online sooner or go get a high paying job, uh, that I could do
Right.
it. So, kind of just talking this out with you helps me be like, okay, my allocation is adjusted for my risk personality as well as
Hmm.
my belief in my own ability to earn money. So I
Right.
appreciate you kind of like helping me think through it, because I'm like I've been like, oh god, should I go like less aggressive, more conservative in this period, or should I just stay aggressive and just keep working on growing the online income and or being open to another job opportunity if the right one came
Right.
along.
Right. Well, good luck.
uh yeah. Well, thank you. Okay, so next subject. So bonds are not dead. Bonds are still a key part of the simple path to wealth. And just to recap again, for listeners who maybe didn't hear the first episode, Jail's approach to the simple path to wealth is you could potentially, during the wealth accumulation phase, be 100% stocks, meaning VTSAX or VTI, which is the ETF version, up until you move into the wealth preservation phase. And the wealth preservation phase is Jail's nuances. I love it because uh, traditionally it was like you work for 40, 50, 60 years and then you retire. But now people are going in and out of work, right?
Right.
Throughout their career, they take a career break, a sabbatical, etc. And so JL promotes this idea of, instead of thinking in terms of like, your 40, 50-year working career and then retirement, that you're either in the wealth accumulation phase, meaning you're earning money and contributing to your investments, or you're in the wealth preservation phase, which is you're not making money and you're living off of your portfolio. And
Exactly.
someone could take a break during their career. They're, let's say they're 37 years old and they want to take 2 years off, and so they shifted from wealth accumulation to wealth preservation. And during that time that they're taking a break, they would want to shift their asset allocation to include bonds, because in the wealth preservation phase, you're then moving from 100% stocks, aka VTSAX, to then layering in a percentage of bonds, VBTLX or BND, which is Vanguard's versions, to an allocation that is adjusted kind of for your situation as well as your risk aversion. Did I get that right, JL?
You got it exactly right, and well said.
Cool. And then one note, me and JL are big fans of Jack Bogle and Vanguard, but there are versions of VTSAX and VBTLX with Fidelity, Charles Schwab, etc. So you don't have to get those specific investments, just as long as they're in the same index.
Right. So that's a great point. I have a preference personally for Vanguard for a variety of reasons, but what we're talking about here is broad-based, low-cost stock and bond index funds. And VTSAX is an example, or VTI, which is ETF version, is a total stock market index portfolio. Fidelity, I forget the ticker
S
for.
SWTSX.
Okay, thank you. So Fidelity has their version, Schwab has everybody has their version, and a total stock market index fund from any of them is fine. And I'll go a step further. You can also use an S&P 500 fund very effectively, whether it's out of Vanguard or Fidelity. So if you're listening to this and you're hearing us say we prefer Vanguard and these specific funds, and you're invested in Fidelity and you like Fidelity, and then don't buy a Vanguard fund at Fidelity because you'll incur extra fees. Buy the Fidelity version of these funds, and that will serve you well.
Yeah, and one point I'll add because I had to figure this out for myself as well as help some coaching clients. Oftentimes, people's 401k um, or 403b or other
Right.
employer sponsored retirement accounts actually don't have a total US stock market index fund, but they almost always have an S&P 500 index fund. So if you're like, wait, I am in the wealth accumulation phase, I want to make sure I'm in 100% stocks, you can go to your 401k or 403b or 457 or TSP, and there is an S&P 500 index fund, which is JL and I talked about it in our last interview, but they're essentially perform the same. So JL
Right.
has a preference for the total U.S. stock market index fund over the S&P 500, but the performance is pretty similar, so you can swap them.
Yeah. So the total stock market, the S&P 500, as the name suggests, is the 500 largest U.S. based companies. And because these funds are cap weighted, the total stock market index fund is largely made up of those same 500 companies. But it also has some mid cap and some small cap companies. So it's about, I don't want to say 80, 85% S&P 500, which is why they track so closely. As you said, either one of them could serve you well. I too get this question all the time. Typically, when people go looking for it in their 401k and they only see the S&P 500. The reason I prefer the total stock market is the same reason I put Tabasco on my eggs. It just adds a little spice that I enjoy, but it's certainly not necessary.
Yeah, and by spice you mean it gives you some small cap exposure and some mid
Exactly.
cap exposure, correct?
Exactly.
Yeah.
Yeah.
And yeah, just I brought it up while we were talking. So Vanguard VTSAX, that's the total US stock market. Charles Schwab is SWTSX, and then Fidelity has their own fund, FZROX. So uh
There you go.
and the reason I bring that up is sometimes if you're trying to buy a Vanguard fund on a different brokerage, they might hit you with a fee. And another key part of JL's teaching is avoid fees and keep
Avoid
costs
fees.
low.
Yes, absolutely. Fees are a drag on your performance, and they seem perhaps nominal at the moment, but compounded over time, they can be extraordinarily significant. So yes, as Jack
Yep.
Bogle once famously said, performance comes and goes, fees are forever. They never
Yeah.
they never go away.
Yeah. Which is before we talk about international, actually we didn't talk about this in our last conversation. And I've talked with individuals, friends, clients, etc., about the fact of avoiding financial advisors that charge a fee.
Right.
Um, because the simple path to wealth, you encourage people to manage their own investments. So could you speak a little bit to why it's so important to avoid those investment fees or advisor fees? That because I know a lot of people listening to this are like, oh yeah, I just have my financial advisor like doing all my investing for me, like why should I do it myself? Like that's too much of a headache.
Yeah. So I'm going to back up a little bit in answering that question because uh, people have the sense that investing is extraordinarily complicated. And they're not wrong because Wall Street continually promotes and markets extraordinarily complex investments. So, when people think investing is complicated, that's the reason. That's the bad news. The good news is you can put your arm on the table and sweep all that complicated stuff off onto the floor because all you need, as we've been talking about, to be successful, not and to be more successful actually than all those high fee complicated things are just these very simple low cost broad based stock and bond index funds, and they are the soul of simplicity. So you don't have to even think about all that complex stuff that an advisor, for instance, might be able to explain to you because you don't care about that stuff. If you read The Simple Path to Wealth, you know exactly what you're going to buy, and it is the soul of simplicity. There is no need for that advisor. But let's talk now about the fees and why it's so significant. And the easiest thing is just a little back of the envelope math. We talked a moment ago about 4% withdrawal rate, which is kind of a benchmark of a withdrawal rate that is very conservative. In the vast majority of situations will comfortably last 30 years, meaning your money lasts for that amount of time when you withdraw at that rate and adjust every year for inflation, which is a pretty big ask. But so that's 4%. So again, if you've got that $1 million, you're pulling 40,000 a year that you're living on. Now, let's suppose that $1 million is with an advisor, and that advisor charges you just 1% of your net worth annually to manage your money. And you say, well, gee, 1%, that's nothing. That's 1%. Why would I worry about that? Well, that 1% of $1 million is $10,000. That is 25% of the 40,000 you would be pulling out to live on every year. So that fee is only 1% of your total worth, but it is 25% of your annual income that you're living on from your investments. So there are other ways to calculate this, looking at how that 1% coming out compounded over an extended period of time grows to enormous numbers.
Yeah.
And you can seek out those calculations too. But I like this one because it's just so simple, because it never occurs to people that it's 25% of your annual income from your investments.
Yeah.
Uh,
Yeah. I mean, and it's compounding cuts like all ways, right? So if you're paying 2% in a fee and you have $2 million invested, you're paying somebody $40,000 a year.
right.
And this is all stuff you can learn easily to do for yourself in The Simple Path to Wealth. Like, just read the book and you'll be like, oh my God, JL made it so easy for me.
Yeah,
We've explained.
you could pay $40,000 a year every year in fees, or you can pay $30 for the book.
Yeah. Yeah, exactly. Okay, let's switch gears. I want to talk about international because
Sure.
I'll give you a good setup, because I when I got serious about investing towards the end of 2017, I read your book, but then I also read all the other stuff about like the 3-fund portfolio, and you should have international exposure.
Right.
And so I put a portion of my investments into international. Now, I
Right.
didn't go as aggressive as like some of them recommend, which is like 25, 30% of your portfolio in international index fund. I was much lower, like I think around 10 or 15%. But then 2 or 3 years ago, I was like, this stuff is not performing, and it's just making it even more complex for me. So I just sold all my international and put it in VTSAX. But now, of course, with kind of like what's going on with the stock market this year, for the first time in a very long time, I think 15 plus years, the international like index fund, like Vanguard's, like, I don't know what the fund is, but the ETF is VXUS, is like up significantly more than the total US stock market. So my question for you, JL, is one, what is your stance on like whether or not to include an international index fund in your portfolio? I know your thoughts, but we didn't talk about this in our last
Yeah.
conversation. So I want you to share your thoughts. And then I have some follow-up questions, but I'll try to be a good interviewer and ask one question at a time.
I appreciate that. So first of all, people listening should understand that I am very much the odd one out on this subject. Virtually everybody else who talks about investing and investing approaches recommends that you have international exposure. I don't feel the need, and I don't feel the need for three reasons. One is that those top companies, those S&P 500 companies, are almost entirely international businesses. They operate on the world stage. So I absolutely expect the rest of the world to continue to grow and prosper as it has done ever since World War II. So it's not that I don't think the rest of the world is going to do well. It's just that I already own companies that will benefit strongly from that growth and profitability in those other parts of the world. That's reason number one. Reason number two is there is no country in the world that has uh, secure in its regulations around investments, protecting investors than the U.S. So there is inherently less risk of bad behavior in the U.S. Now, to be clear, that doesn't mean that there is no risk of bad behavior. I mean, you had Enron blow up to everybody's amazement back in '08 or '09, I forget which. So bad things that can happen even here. But it is the best, most secure place in the world for that. And then the third reason, which candidly has been diminished over the years when I first started writing about this, is that adding international is more expensive in fees. Now, Vanguard, as an example, has dramatically lowered its fees on its world index fund, which invests in the United States and everywhere else in the world, which is where I would go if I were to add international. But it's still, I think it's down to the expense ratio is down to like 0.07%. And, the VTSAX is at 0.04. So it's still almost twice as much, but that's 0.07 is certainly a modest fee. So that's not so much of an issue anymore. The one reason that you mentioned that is not part of my consideration is performance. So this year so far, the U.S. market has struggled. It's lagged. It's been very volatile. Whereas the European market, and I haven't looked in the last couple of weeks, but I suspect it's been the same. The European and Asian markets have done very, very well, and they have handily outperformed the U.S. market. And as you mentioned, that's something that we haven't seen happen for about 15 years. So for 15 years, you also got a great benefit being all U.S. in terms of it just outperform anything else international that you held was a drag on your performance. But that's not the reason I do it, because that too goes in cycles. And it's not just because of the current political turmoil. There have been many times in the past when the international markets have outperformed the U.S. market for extended periods of time. That's just a natural part of the process. So that doesn't figure into my thinking. Again, just like we were talking about the market in general, right now, European and Asian markets are outperforming. I don't know if that's the beginning of a 5, 10, 15-year trend, like the US outperformance has been in the last 15 years, or if it's a fluke and the US will go back to dominating. I just, there's no way to know that. But that doesn't figure into my thinking.
So my follow-up question is related to this. Let's say, someone in their 20s or 30s, or even someone like me in their 40s who's, like, I may live to be 100, 110 or longer for all I know with what's going on with all the, longevity science and research.
Right.
You know, is someone that has, a 80, 60, 80 plus year horizon, are they better served staying 100% US stocks or going something like Vanguard's Total World Fund, which, I believe is 60% US and 40% international?
Right. So first of all, you're correct about that. So the World Fund is about 60% US because the United States accounts for about 60% of all publicly traded companies in the world.
Yeah.
So you look at China as an example. China has a very large economy, large enough to be competitive with ours, but they have a fairly small stock market.
Hmm.
So there's not a lot of ways to participate in the Chinese market. Uh, Let me start out by saying when I talk to international audiences, I sing a little different tune. And
Mm.
the reason for that is the US is the only country in the world whose stock market is large enough and dominant enough that we can get away with owning only that. Because as
Mm.
we just discussed, it's 60% of the world market. There is no other country in the world where I would recommend to somebody who is a citizen of that country that they only buy Chinese stocks or Japanese stocks or German or French or Canadian or anything else. Those markets are just too small. So for them, I'm already saying buy the World Fund. I wouldn't want to own 100% US if I were a Brit or a German or Japanese, just because it feels awkward being 100% in another country's stock market. So I'd already go to the World Fund. And part of that reason is I do see a time in the future when the US will no longer be dominant enough that we Americans can get away with owning only our own stock market. I don't see that happening anytime soon. There's a lot of talk these days because of the political situation that the American empire is about to end and all this kind of stuff. All empires end eventually, and that will certainly happen to the American empire, but I don't think it's going to happen suddenly, and I don't think it's going to be happening soon. I do tell my daughter, who's got the same kind of time horizon that you described, this is something she wants to pay attention to. And at some point, if she sees the U.S. dominance in the world stock markets beginning to diminish, not necessarily because bad things are happening in the US, but just as the rest of the world continues to grow and prosper, you might want to make the switch. So if you go back to the end of World War II, the US was essentially the entire world economy because Europe was in ashes, Asia was in ashes. We were the only country in that war, along with Canada, I suppose, that it wasn't fought on our soil, right? So, and then we set about successfully rebuilding the rest of the world, which was great for them, also great for us, because that gave us sources of products to buy and markets to sell our products into, and that's one of the reasons the world has grown and prospered dramatically for the last 80 years since World War II. I see that trend continuing. So where the US used to be probably 90% of the world market, now it's 60%, and so eventually I think that even in the US you'll want to expand into something like their world fund. Having said all of that, I have people who come to me and they'll say, JL, I get it. I understand what you're saying about that international stuff, but I still think I want to own it. You don't get big pushback from me. I mean, if you're saying, hey, I think now's the time to go to that World Fund, I wouldn't. I'd be very uh, discouraging about not holding the U.S. at all and just going to a fund that was ex-U.S. because you're just leaving too much on the table. But if you were to say to my daughter were to come to me and say, hey, Dad, I think the time's come. I'm going to move into that World Fund. What I would say to her is, I think you're early, but it's not going to hurt you to do it. And if you want to be ahead of the curve, you won't get any great pushback from me.
Yeah. I'm just thinking through like my own situation because
Sure.
I'm like, okay, I hear what he's saying. So I guess I just have to pay attention to what's going on with the US and the rest of the world economies.
Or you
And
could buy
then,
the World Fund and call it a day. you know.
yeah. But then it's like, it's still, if you look at it over the last several years, the US still totally outperformed the World Fund.
Absolutely.
Um, and
But that might not be the case for again, this is not the reason to invest internationally or not to invest internationally. Performance comes and goes, right?
yeah,
So it might be that, the World Fund will outperform for the next 15 years
yeah,
as Asia and Europe, or it might be that this outperformance from Asia and Europe for the first part of this year is just a momentary blip and the US will go back to dominating. I don't know the answer. Nobody knows the answer to that.
yeah.
So
So
you make your investment decisions based on that kind of unknowable stuff.
yeah. So I guess like I know like a lot of your investment, teaching is kind of aimed at your daughter. So just gonna ask you. So like, how do you kind of prepare your daughter for like switching into a like? How does she think about when it's a good time to switch into a world fund?
Yeah, so I'm going to back up on answering that question a little bit too. So all of this stuff that I've written, starting with the blog in 2011, was fundamentally to archive this information for my daughter because I'd managed to turn her off to all things financial by pushing it too hard and too soon, right? And I wanted to make sure that, in case I was dead, candidly, when she was ready to hear it, the information would be there. So that's the root of it. And when she was in college, uh, probably back around 2010, 11, in those years, she came home one day, for Thanksgiving or whatever it was. And I, of course, immediately began lecturing about how important investing was, blah, blah, blah. And she stopped me and she said, Dad, I get it. I understand it's important. I just don't want to have to think about it all the time. And that was an epiphany for me because at that moment, I recognized, I'm the odd one out. People like me who love this stuff, we're the odd ones out. Most people have better things to do with their time. They have businesses to build and bridges to build and diseases to cure uh, but they're like my daughter. They're smart enough to know that if they get this financial stuff right, it can make their world so much better, open up so many new opportunities as you build wealth. But they don't want to have to think about it all the time. And that was the beginning of thinking in terms of the simple path to wealth, where you just need to understand a couple principles that we've been talking about, implement a couple of investments, these broad based, low cost index funds, set it on autopilot, and then you are done. Then you can go on to, nursing in the hospital or building bridges or teaching or whatever it is that speaks to your soul, right? And one of the things that I've learned, Justin, is that I have two audiences, broadly speaking, right? It's the audience of people like my daughter for whom I've written this stuff, who, like my daughter, are embracing it and they buy those low cost index funds, they set it on autopilot, and they go about their life. And they will never be tempted to panic and sell when the market drops because they probably won't even notice that the market's dropping because they have better things to do with their time. But the other part of my audience, not surprisingly, I suppose, are people who do love this stuff, who are very engaged with this investing thing. And those are the people who are always coming to me and saying, hey, JL, I really love the simple path to wealth. It's great. But if you just added this little thing or this little thing, then it would be statistically, and I've done the back analysis, and it would be even better. You'd make even more money. And, you know, those are the people who are constantly going to tinker with it. Those are the people who think, oh, if they just add this one thing, it's going to make it better. And then 6 months or a year from now, oh, here's this other new thing. That'll be even. I'll get rid of that thing and I'll go into this other new thing. And so chasing all the shiny object. And I will bet large amounts of money that at the end of 20 years, my daughter, who never even looks at it, will have outperformed those people who are tinkering all the time.
Yeah.
So I'll give you a great example. Paul Merriman is a friend of mine, very, very smart guy. He's been writing in this space for a long time, and he's done great work to help an awful lot of people. And he recommends a 4 fund portfolio. And I figured exactly what the 4 funds are. I know one of them, because he's a huge proponent of this, are small cap value funds. He's a big believer in small cap value. And Paul tells me, he says, JL, I've done the research and I've looked at VTSAX as it performs over time. And then I've crafted this 4 fund portfolio. And if you adjust it, you're 25% in each one, and then you adjust that allocation, when one starts to outperform and the other underperforming, you sell some of that to build up so that you stay at that 25%. And if you do that for 20 years, at the end of that 20 years, my fund will have, my approach, these 4 funds will have outperformed VTSAX by, I think he says, 1% or maybe 1.5%, which doesn't sound like much, but compounded over 20 years is pretty significant. Paul's a smart guy. And as I've said to him, because we've debated this in public, uh, I, I trust your work. I trust that's what the data shows. But what I can promise you is no one is going to follow that approach reliably for 20 years. I have enough trouble getting people not to panic and sell the one fund every time the market drops 5%. The idea that over 20 years, somebody is going to sell their fund that is performing well to buy the funds that are not performing well, smart thing to do. It will give you a great result, but it is so fundamentally against human nature. And just the idea that anybody would consistently do that kind of work reliably to get there. So, what Paul recommends theoretically, yeah, probably beats my approach. Practically speaking, it's going to be a very, very rare person that actually executes it well enough to outperform my daughter.
Yeah. I completely agree. It is, we talked about it a little bit in our last conversation on the show. It is so hard to sell a asset that is performing to then put that money into something that's not performing.
Yeah.
And I'm speaking of, like, I have these individual stocks that I've had forever, and it's so hard to unwind them because it's like, well, maybe they'll keep performing more. And so with Paul Merriman's 4 fund portfolio, he's literally saying, like, when one grows to 30 or 40%, you have to take that one that's been performing really well and you have to sell it and buy one that hasn't been performing
Right.
as well. And like you're saying, that is totally against human nature. Like, we're going to want to keep the one that's quote unquote winning and not buy more of the one that's losing.
Right. So it's even a little bit worse than you're describing, because not only is it asking you to sell that one that's done well for you, but then it's asking you to take that money and turn around and buy something that's done poorly.
Yeah.
And by the way, let me be clear. I don't mention Paul to pick on him and or in any way to denigrate him and his performance. I mention him because of all the people out there who are recommending things that require tinkering. His is probably the best, the
Yeah.
strongest, the most sound approach. So I bring him up precisely because I have so much respect for him and the work he's done and the strength of his approach. And as I said to him privately and publicly when we've been debating these things privately, I concede that if somebody follows his approach, they will probably outperform over 20 years.
Yeah.
But I'm very skeptical that people will actually do that. And I'm sure there'll be a couple, but those are going to be rare cats indeed.
Yeah. Okay. Let's talk about Bitcoin and crypto because that's also, it's back in the news. It's broken over, a single Bitcoin is over $100,000. And, everyone's, talk. I was just, and I know you're not supposed to argue with strangers on the internet, but I was arguing with a stranger on the internet who is 100% in Bitcoin, and and they're telling me that, I should take all my index funds and put it into Bitcoin because the returns are so much better. So, I'm curious, what is your stance? I mean, I know your stance on Bitcoin, but I kind of want to have you share your stance with my audience and then also ask a couple follow-up questions around that.
Okay, so first of all, I have to, because you mentioned arguing on the internet, I have to share with you and our listeners my all-time favorite, one of my all-time favorite cartoons. Excuse me. So there's the images. There's a guy at his computer. He's kind of hunched over and obviously working very hard. And in the doorway, there's a woman, presumably his wife, very attractive woman, dressed in a very alluring negligee. And the guy is saying, "Just a minute, honey. There's somebody wrong on the internet." So
Yeah. I
priorities.
don't do it often, but I was just going back and forth with him trying to be like,
Yeah.
okay, I'm not against Bitcoin. I'm saying don't put all your money in one like single asset. Like that is crazy to me
I just hope
personally.
your wife wasn't in the doorway in her negligee waiting for you to come back. Yeah. So having said that, one of the one of my favorite parts of the new edition of the Simple Path to Wealth is I now have an FAQ section. And one of the reasons that's one of my favorite parts, it allows me to address questions that I have gotten since 2016 when the original came out that I don't think belong in the core body of the book. And crypto is one of those. So I answer this crypto question in that FAQ section. So here's my take on crypto. And by the way, nobody, including your friend on the internet who is into crypto, cares about what my opinion is, right? Nothing I'm about to say will change the true believers at all. But this is my take on it. So crypto was, of course, originally developed to be a currency. And there were high expectations that it would have advantages as a currency that currencies issued by government would not have. There is the famous story of somebody who spent 15 years ago or whatever 10,000 bitcoins to buy two pizzas, and those 10,000 coins would now be worth $1 billion or something, right? So great illustration though of why crypto in general and Bitcoin in particular does not function as a currency other than in illegal transactions. It is simply too volatile. For a currency to function as a means of exchange, it has to have a certain amount of stability because no buyer is going to want to spend a currency that they think is going to be worth more tomorrow than it is today. No seller is going to want to accept a currency they think is going to be worth less tomorrow. So that's one of the reasons that inflation is so dangerous to an economy, because it makes the currency unstable as a means of trade. And deflation does the same thing. So crypto, other than for illegal activities because it's untraceable, is really not functional as a currency. So what it is basically is a speculation, and I am not a speculator. So I'm an investor. So what's the difference between a speculation and an investment? Well, speculation is when you buy something with the expectation and hope that at some point in the future, somebody will pay you more for it than you paid for it. And that's crypto in a nutshell. And so far, crypto's been very volatile, but so far it's worked out very well as a speculation. Make no mistake. I mean, sure, I wish that When that guy was buying pizzas with 10,000 Bitcoin, I was the one selling the two pizzas, and I'd kept those 10,000 Bitcoin. That would have been a very successful speculation. Problem with speculations is they don't always work out. And you don't know whether the crypto speculation is going to continue to work out well or not. Nobody knows that. An investor, which is what I am, invests in companies that are actively working to manufacture and offer products and services that people value and will pay money for. And to the extent that they do that, their income grows. And if they do it efficiently, they will take in more money than it costs them to do it. And that's the profit. And in a public market like the stock market, we can own a piece of those companies and we can benefit from that economic growth. So when I own VTSAX, I own a piece of every publicly traded company in the United States of America, and everybody from the factory floor to the CEO is working to make me richer. When you buy Bitcoin, there is nobody working to make you richer. There is just a speculative market that Bitcoin may be worth more than you paid for it at some point in the future. This is the same, by the way, with gold, which is why I don't invest in gold or silver or artwork or classic cars. All of these things are speculations. And if you want to speculate, that's fine. You do whatever you want to do. I mean, personally, if you're speculating in art, at least you have something pretty to look at on your wall, or in classic cars, something that you can enjoy tinkering with and driving around. Holding Bitcoin in a Bitcoin wallet doesn't have those attributes, but there you go. So that's my take.
So for somebody, and I'll use myself as an example, I like to play with a little bit of my money. So
Right.
I do have some Bitcoin, but it is, probably at most 2 to 3% of my total portfolio. Is that acceptable within the simple path to wealth framework? If I know you do not condone entertaining yourself with your money, but like I just can't help myself.
So go and sin no more, my son. You are forgiven. So yeah, I am. Again, this is where I'm out of step with the rest of the financial world, I suppose, because most people who write and talk about this say, "Hey, if you want to take 5 or even 10% of your money and play with it in speculative investments, then yeah, go for it." Uh, I don't expect my money to entertain me.
Yeah.
I just expect my money to make money for me. And I find entertainment elsewhere. So I kind of cringe at the idea of I'm gonna invest in Bitcoin or because it's entertaining, or meme stocks because they're entertaining. Uh, and by the way, I used to be a stock picker, and so I appreciate when you go researching a company and you find one that looks attractive and you do your homework and you pull the trigger and you buy it and it works and it goes up. There are few things in life more intoxicating than that. So I get it. And I'm sure when people bought Bitcoin at $70 a share and it's now at 110 or whatever is it, that's a very intoxicating feeling. So I get that. But it's, I think, a very dangerous game to play. If again, nobody's going to listen. And people who are inclined to do this are not going to listen to what I'm saying and change their mind. And that
Yep.
includes you. So if
Yep.
you're going to take a small percentage of your net worth and play with Bitcoin, then
Yep.
okay. The idea, by the way, though, that it is going to dramatically move the needle at this point, uh, which is what everybody's hoping for, I think is naive. Because from $100 a share, it's not going to go up the 10,000% or whatever it's gone up since it was $1 a share, right? So
Yep.
that's probably not in the cards because, as the saying goes, trees don't grow to the sky. Can you make 40 or 50% is when it goes to 70 to 110? Sure. But equally, you can lose that in a heartbeat as well. And Bitcoin has a record of that kind of volatility. So I
Yeah.
think the idea of becoming a Bitcoin billionaire with a 50 or $100,000 investment, I think those days are probably over. There's probably something else coming up that in hindsight will have provided that function. But there's a lot of things coming up, and most of them will crash and burn.
Yeah.
So the idea that we'll happen to pick the one that works is, takes an enormous amount of luck.
Yeah. And I say this to people, like to friends, to clients, to people online. I don't know a single person in real life that has become like a crypto millionaire. I've seen plenty of them on the internet, but I've never met a person in real life who is like a crypto millionaire or multimillionaire, and like I know them.
Right.
Yet I know dozens, if not over 50 people who have become millionaires, multimillionaires with index investing, like with the, simple path to wealth strategy. And like many of them are good friends of mine. And that is just like, for me, like, I'm sure one day I may meet one, but like, you have this saying that like fast money is fragile. Like, I think that is so true. These people who I'm sure there's people out there who became, Bitcoin or crypto millionaires, but like they got it. It was so easy that it's like they didn't have to work for it. So, just like lottery winners, they're gonna probably squander it.
I think that's a point well taken, on a slightly different subject, the subject of market timing,
Hmm.
which is a siren song for an awful lot of people. Jack Bogle once said, I've been in this business for 50 years. I've never met anybody who could successfully time the market. And I've never met anybody who could do it. And I've now been an investor for 50 years. And I too have never met anybody who could successfully time the market. And I've never met anybody who has met anybody who could do it. And I think it's the same thing with Bitcoin. You're right. There are probably some people for whom that's happened, just like there are lottery winners. And you're also absolutely right that money that comes easily is not sticky money. Money that comes to you if you follow something like the simple path to wealth, where it comes reliably but slowly and builds over time and allows you to become accustomed to it, learn how to handle it and respect it, that's money that's sticky, to use your term, right? Money flees where it's not well treated, where it's not
Yeah.
respected, where it's not understood. And it flees into the pockets of those people who do respect it, who
Yeah.
do understand it. And that's one of the reasons that statistically large lottery winners tend to not only lose all that money, but wind up bankrupt because they wind up going into debt and what have you. It's money is a tricky thing. It requires some knowledge and expertise to deal with it. It's a responsibility. And
Yeah.
if you come by it too quickly, too easily, you probably don't have the chance to really learn what you need to know. This, by the way, is not only with people who got lucky with Bitcoin or who got lucky in the lottery, but professional athletes.
Yeah.
Who suddenly come from poor backgrounds or average backgrounds, and they're suddenly making huge amount of money. There's just too many tragic stories where they frittered away. Now, by the way, that seems to have changed with athletes because there is an awareness amongst professional athletes because of candidly conversations like this that they have to pay attention or the money will slip away. I use Mike Tyson in my book as an example. Mike Tyson made $400 million in his career and wound up bankrupt uh, just because nobody ever explain to Mike Tyson how money works. And he was surrounded by sharks who were pulling chunks of it away from him because they knew he didn't know how it worked. So those kinds of things are tragic. And by the way, it's not just athletes. I mean, doctors fall into this trap. Doctors go through law school, they live very modestly for a long time. Suddenly they go out as a surgeon and they're making huge amounts of money. And they're very, very smart people who have developed a real expertise in something, but too often they make the mistake of saying, "Hey, I'm a really smart guy who knows how to cut people open and save their lives. How hard can this investment thing be?" And they wind up suffering attorneys.
Yep.
You can be a very powerful, high income attorney, but not know how to deal with that money.
Yep.
So it's a different kind of thing. So it's not just athletes, but anybody for whom money comes suddenly and in large quantities is at
Yep.
risk.
Yeah, I've seen the same thing in technology,
Right.
enterprise sales, like, because, in the Bay Area and New York and, major metropolitan areas, like someone in technology, B2B sales can do 500 to a million plus a year.
Right.
And I know plenty of them, and they have 2 leased Range Rovers and a beautiful, stunning home. And they've built this beautiful glass house, but they're literally just a few paychecks away from everything falling apart if they lose that high income. I consider myself lucky that I discovered the simple path to wealth as I started making a lot of money in sales. And so I was like, I'm not going to go down that route, because in my previous career working in Hollywood nightclub business, where I watched all those athletes come into the nightclubs, and I literally, jail, no joke, watched them spend 10, 20, 30,000, $100,000 on bottle service in a single night on champagne bottles.
No, I understand. Yeah.
And like, so I know exactly these athletes you're talking about. Now, I haven't been in that industry since 2013, so I don't know if the athletes are any better about it. But like, it was insane watching people spend money like that. And it wasn't just the athletes; it was, people from Wall Street. It was, doctors. It was lawyers. Like all these high earning people, they would come in and they would just show off their wealth. And I'm sure many of them were not following the simple path to wealth and actually building any wealth with all that money they were
Well,
making.
and it's because they only understand money in terms of what it can buy.
Yeah.
They don't understand it as a tool. And part of my book is understanding money. And money can certainly buy things, but it can also be a tool. You can turn around and invest it, and that's what most people don't understand about money. So
Yeah.
if you go out and randomly survey a group of people and you say, what would you do if you suddenly won $1 million? The vast majority of those people are going to say things like, well, I'd buy my house. I'd buy a house, and I'd buy my mother a house, and I'd buy this truck I've always wanted. And I bet you they'd be talking about the things they could buy with that $1 million. And of course, if they had that $1 million, that's exactly what they would do, and then the $1 million would be gone, right? You very rarely are you going to have somebody say, well, I would put it in VTSAX, and I'd pull the 40,000 a year that it would throw off. Right? That's a whole different mindset. I was
Yeah.
a number of years ago, I was being interviewed by a woman in the financial world. And I always try for a new interview to listen to a couple of their episodes so I get a feel for the interviewer. And I noticed that this woman always asked the same question at the end of her interview, which was, what would you do if you suddenly had $100 million? Well, that's an easy question for me to answer. So we go through the interview. And of course, like you and I have been talking, we've been talking about index investing and VTSAX and all this stuff. And we get to the end of the interview, and she throws that question at me. What would I do with $100 million? And I said, I'd put it in VTSAX, and I'd I'd spend what it threw off. And she was a little stunned at the answer because most people talk about what they would buy. And she said, really? And I didn't say this, but what I was thinking is, did you listen to this interview?
Yeah.
Because if you listen to it, you should have been able to anticipate that that's what I would do. But that's absolutely what I would do if somebody gave me $100 million. So anybody out there listening who wants to give you $100 million and wants to test me on this,
Yeah.
I'm open to the challenge.
Yeah, I mean, it's true too. And people don't realize that if you put that 100 million, I mean, people who've read The Simple Path to Wealth and
Right.
understand financial independence, you put that 100 million into VTSAX and you take 4% out per year for the rest of your life. That means 4 million that you get to spend per year, adjusted for inflation every single year. Like, if that's not enough money to live an incredible life, then
Meanwhile, your 100 million, in all likelihood, will continue to grow to even larger amounts.
yeah,
So
exactly.
yeah,
So, last question that I want to
sure.
ask, because this also comes up a lot for me, in my discourse with, people in my work and in my interactions online, is what about the people who only make, like, they live in the U.S. and they only make $50,000 or $60,000 a year, like, does the simple path to wealth work for them? Can they actually achieve financial independence? Because they're like, I just don't make enough money to be able to achieve, any sort of financial freedom. And I just want to kind of like hear what you would say to somebody like that.
Yeah. So the short answer is absolutely, it can work for them. And this is this notion is one of the things that is most troubling to me, because the reason people in those levels believe that is because they are constantly told that they don't have a chance, right? The whole reason I did Pathfinders, which is a book of 100 stories of people from all over the world, including the US, who have followed the simple path to wealth with great results, is because I heard so many stories from people with very humble circumstances who were achieving great results. What people need to understand, so in Pathfinder, to be clear, in Pathfinders, you'll find stories of people who work in technology like you did, who made big incomes and did well with it. So those stories are also valid. But you'll also find the story of a guy who was a migrant fruit picker, and he's writing about how he'd accumulated $500,000. There's a story in there from a woman who talks about when she was growing up, the rich people were the ones who had flush toilets. So I can almost promise anybody who's listening to our conversation now, if you pick up Pathfinders, you will find stories of people who are following the path who probably have more challenging circumstances than you do. So it's absolutely possible. And I'll just finish this. I have an old friend from high school who's never made more than $50,000 a year, and he has achieved financial independence. At the same time, I have a friend, I've kind of lost touch with this guy. I have a friend that I used to know who was in the financial business. And this goes back to the early 90s. It was just before Christmas. He and I were in Chicago. He was living in Chicago at the time, and I was visiting, and we were having lunch. And he just gotten his annual bonus, which was $800,000. And so he made, I don't know, $2.5 million on the year, right? And this is back in the early 90s when that was real money. Okay. And you know what we talked about at lunch? We talked about how it wasn't enough to live on his income. And you're laughing. And I imagine most people listening to us are kind of rolling their eyes. But I'll tell you what, when he walked me through, because he was one of these people who's very candid about his income and his expenses, when he walked me through his house, his vacation house, the private schools, the leased cars, the exotic vacations, all of which were, you start adding that stuff up. And he was absolutely right. He was not making enough money to support that lifestyle, let alone to begin building towards financial independence. So the conclusion I've come to is not that people who have very modest incomes can't do it, because I've heard too many stories of where they can. I think in many ways, people who have large incomes are less likely to do it because there are so many ways to inflate their lifestyle to take up every dollar they earn and then some, that they're never going to get there. So my 2.5 million a year friend is never going to be financially independent. My max $50,000 a year friend got there. So it's not a function of a certain amount of money, like you have $1 million or $5 or $10 million, and then you're there. It's a formula between what you spend and what you have, right? So if you're like my financial friend who's created a lifestyle that requires an enormous amount of money to maintain, my other friend created a lifestyle that required a very modest amount of money to maintain, which also meant it required a very modest amount of money invested to throw off that amount of money to account for it.
Yeah.
So if we go back to our friend Mike Tyson, he had a lifestyle at one point that I think he was spending $50 million a year. Well, even with $400 million, you're going to blow through that, as he did. So yeah, I hope that nobody listening to this accepts that trope that is so common in our culture these days, that this is only for somebody making a big income, or if you make below X amount of money, you can't possibly do it. It's not easy, but it is simple, and you just need to adjust your life in order to free up that money to begin building your wealth.
Yeah. And in the book, The Simple Path to Wealth, like you do a great job of breaking down, it really comes down to your savings rate. What percentage of the money you make are you actually keeping and then investing, which is part of your simple path to wealth, which is spend less than you earn,
Right.
invest the surplus, and avoid debt. And so whether you make $50,000 a year, if you can, create a lifestyle that only costs 25,000, then you can invest the other 25,000 per year. And then eventually you do that for 10 to 12 years and you're going to be financially independent. Whether you make $50,000 a year or $100,000 a year, if you can save and invest 50% of it, you have about a 10 to 12 year journey to financial independence, which is like, that is the thing that blew my mind once I understood that it didn't matter how much money you make. It was just a function of how much of the money that you made that you kept and invested. And that is the simple path to wealth.
Yeah, well said. When I came out of college in 1972, in the middle of that period of stagflation, a really terrible economy, it took me 2 years to get my first professional job. And I did landscaping work for that 2 years to pay the rent and put food on the table and what have you. My first professional job, which I got in 1974, paid me $10,000 a year. Now, to be clear, adjusting that for inflation, and I haven't looked recently, but $10,000 a year then is roughly $50,000 now. So it would be the equivalent of making $50,000. I just arbitrarily, because there was no internet in those days, there was no infrastructure support like we are providing to people. I knew I wanted to have what I called FU money. And I just arbitrarily said, I know I can live on $5,000 a year. I know this because I can see other people doing it. It is a whole lot more than I was making doing landscaping. And landscaping was a whole lot more than I was living on putting myself through college. So it was actually a step up in lifestyle for me. And then I invested the other 5,000, and I kept that 50% ratio throughout my career. So as my income rose, when I was making 20,000. Well, now my lifestyle could double from 5 to 10. And at the same time, I was doubling the amount I was investing. When I was making 100 grand, it was 50 and 50 and on the way. So it is, yes. I mean, I'm sure there are some people who are making so little that they truly can't do it. But I think most people who have been told that and come to believe it, for them, it's a false belief.
Yeah.
And I think that applies to most people who are interested in a program like this, who have, frankly, the technology to listen to a program like this, who are by definition speaking the most useful language in the world. Uh, yeah, if you don't do it, it's probably just because your priorities are different, not
Yeah.
because it isn't possible.
Yeah. And that's an incredible point that you made in our last conversation, which you literally said, and this became a core part of my own teaching to other people, is if financial independence is not your top goal or one of your top two goals, you will not achieve it because other things
Absolutely.
are going to take priority over it. And in my own journey, the reason I achieved financial independence is because financial independence was my number one goal. Once I recognized it was a possibility through the work of JL Collins and some of the other people in the financial independence space, then that became my obsessive number one goal for years until I got there. And, so for the listener, if you truly want to be financially free, two things: get the simple path to wealth and make financial independence your number one goal.
Yeah, I think it's well said. And to be clear, the vast majority of people are never going to do this.
Yeah.
I'm under no illusions that the whole world is going to follow this. At least though, if they listen to us and they read the book, they will know that of all the things they could spend their money on, there is this other thing. You could buy your freedom and you could spend your money to become financially independent. Now, you will probably choose not to because I've met enough people. If you ask anybody, would you like to be financially independent? I think you'd be hard pressed to find somebody to say, no, I really don't want that. Everybody's going to say, yes, I want that. But then when you start saying, okay, here's what you need to do that, what you will hear them say, like my financial friend candidly, is, well, yeah, but I have to live in this house. And my kids have to go to these schools. And I have to have these two leased luxury cars. And I have to have, the European vacation every month. And then, of course, we got to jet down to the Caribbean a couple of times a year because, and then we have to eat out in the best restaurants in Chicago because, they're great restaurants. I mean, that's, again, and I think we talked about this in our last conversation, that's the tyranny of must haves.
Yep.
And so, yeah, you're just choosing to go a different route. And that's okay. It's your money, it's your life. But at least if you've listened to JL and Justin today, you know that there is a different path you could take.
Yeah. Well, JL, it's been such a pleasure to have you back on the show. I'm so excited that your book reached number 7 on the New York Times bestseller list. I hope it continues to climb up higher.
Yeah,
It deserves to be on there. Dead serious to
thank you.
everyone who listened to this podcast. It is the best book I've ever read on money and investing and wealth building. So, and as I said, like, JL teaches it in a storytelling way that is so fun. So even if you don't like reading books, get an audio book version of it. If you enjoy reading books, get the book. And I believe the book is available anywhere books are
It's
sold.
pretty much anywhere books are sold. That's the advantage of going through a publisher now. Yeah.
Awesome. Well, JL, thank you so much for coming on the show, brother.
Hey, man, thanks for having me back. It's always fun hanging out with you and kicking this stuff around.